The adjusted gross income section of the 1040 covers lines 23 through 37. Examples of adjustments for 2016 are educator expense deductions, health savings accounts, moving expenses, individual retirement arrangements, alimony paid, student loan interest deductions, and tuition and fees deductions. Adjustments are considered to be above-the-line deductions. This means that you can claim these deductions even if you don't itemize your deductions on your income tax return. And again, we haven't talked about itemized deductions yet, but we will in an upcoming module. Also, above-the-line deductions aren't subject to phase-outs based on income levels, and they're deductions from your gross income rather than your adjusted gross income. An eligible educator can deduct up to $250 of unreimbursed expenses. This includes classroom materials such as books, supplies, computers, including software, and services or other equipment that an eligible educator would use in the classroom. The amount of the deduction is $500 if married filing jointly, and if both spouses are eligible educators, but not more than $250 each. The deduction is claimed directly on line 23 of the Form 1040. Health savings accounts, or HSAs, are tax-deductible savings plans that allow a taxpayer to save pre-tax dollars for future health care expenses. HSAs are paired with high-deductible health insurance plans. Contributions to an HSA are tax-deductible. Earnings, such as interest and dividends in the health savings account, are tax-exempt at the federal level. Withdrawals from a health savings account are tax-free as long as the funds are used for qualified medical expenses. In other words, a health savings account, or HSA, combines high-deductible health insurance with a tax-favored savings account. Money in the savings account can help pay the deductible, and once the deductible is met, the insurance starts paying. Money left in the savings account earns interest and is yours to keep. There are three ways an HSA can offer tax advantages over traditional health insurance arrangements. First, it reduces your federal income taxes. Regardless of how your income was earned, any money that you deposit in your HSA is considered an above-the-line deduction. This gives you a 100% write-off against your adjusted gross income. Second, reduces your adjusted gross income, helping you to qualify for other lucrative tax breaks that are tied to overall income. By reducing your adjusted gross income, or your AGI, you may also qualify for some additional tax breaks. For instance, the child tax credit of $1,000 per child begins to be phased out once a family's adjusted gross income exceeds $110,000. Keep your AGI below this number, and you maintain the full $1,000 tax credit per child. Third, HSAs reduce your state income taxes. Federal adjusted gross income is also the starting point for most state tax assessments, so saving on your state income tax bill is possible as well. HSAs, or health savings account deductions, are reported on Form 8889. They show up on line 13 of Part 1. Then they flow to line 25 of the 2016 1040, thereby reducing the taxpayer's income. Now let's move on to moving expenses. Form 3903. The best thing about writing off moving expenses is that the deduction is once again taken above the line, meaning that you don't have to worry about all those itemized deduction rules that can quickly dash your hopes of a big tax refund. The worst thing, moving expenses are hard to qualify for. To determine who's eligible, the IRS has set up 2 tests. You pass them and you can cash in. If you fail, you have to eat all the costs of your move. Keep in mind, the IRS lets you take this deduction only if you are moving because of a job, and it doesn't matter if it's a new job, the same job, or your first job. So recent college grads, you need to take note of this. The first challenge will be to pass the 50-mile test. That means the distance between your new primary job and your former home must be at least 50 miles greater than your old commute. For example, if you live 10 miles from work and your new office is 45 miles from your old home, you lose. You can't deduct your moving expenses. If, on the other hand, your new office is 65 miles from your old home, then your new commute is 55 miles longer and you pass the first test. The second test was designed to prove that you moved for work and not just for a change of scenery. It requires that you be employed full-time in the general area of your new job location for at least 39 weeks during the 12 months after you make the move. This means that you're allowed to switch jobs as often as you'd like after the move, and if your employer transfers you again or even lays you off, the IRS won't hold it against you and they'll waive the 39-week test. Well, what if you don't meet the time test before your tax return is due? If you expect to meet the time test, you can deduct your moving expenses in the year that you move. Later, if you don't meet the time test, you must either amend your tax return for the year you claim the deduction by filing a Form 1040-X, amended U.S. individual income tax return, or for the year that you can't meet the time test, report as income the amount of your moving expense deduction that reduced your income tax for the year that you moved. If you're just re-entering the full-time workforce, you can claim the deduction even if you don't have a job when you move, but your new job and your former residence have to be at least 50 miles apart and you must still pass the 39-week test. All right, you've passed all the tests, and now it's time to tally up your winnings. The moving deduction can be significant, but the IRS has become somewhat less generous over the past few years. For 2016, you're limited to the following: the cost of packing and shipping your possessions, including insurance and up to 30 days of storage, the cost of traveling to your new home once, including lodging but not meals. You can also deduct your actual driving costs, like gas and oil, or a whopping 19 cents per mile for 2016. And finally, the cost of disconnecting utilities at your old home and hookups at the new home. Sadly enough, the list of what's not allowed is much longer. This includes expenses incurred in buying or selling a home, or acquiring or breaking a lease, apartment security deposits, losses from selling or giving up club memberships, and driver's license and car registration fees. In the past, you could have deducted expenses incurred while you were out house hunting, but no longer. Once you've rounded up all of your deductible expenses, we complete the IRS Form 3903, Moving Expenses, which is a relatively straightforward form as far as tax forms go. The resulting write-off will show up on page 1, line 26 of the 1040. If you get reimbursed for some or all of your moving expenses, don't get too greedy and try to double dip. You're not allowed to deduct moving costs if they are paid by your employer. There's 2 ways for your company to pay your moving cost. First, it can give you tax-free reimbursements for the amounts you could have deducted yourself, or it can add the reimbursement to your salary. If your employer gives you a tax-free reimbursement, then your job's pretty easy. Do nothing. The expenses have already been deducted because the reimbursement was not included in your wages. The amount of the reimbursement will show up as a miscellaneous, non-taxable item on the W-2 form that your employer gives to you, and you won't have to fill out any extra tax forms. If your employer simply adds the reimbursement of your moving expenses to your salary, then you need to fill out Form 3903 to get your deduction. The same is true if you're self-employed. You'll be able to deduct only what the IRS allows, no matter how much your employer gives you. So, if your boss is more generous than the IRS and pays for things like meals and temporary housing while you wait to move into your new home, then you'll have to pay income tax on that money. Now, we've already touched on line 27, the deductible part of self-employment tax from the Schedule SE that gets generated by the profit on your Schedule C business income. A little beyond the scope of this course, line 28, self-employed, SEP, simple and qualified plans, and line 29 on the 1040, self-employed health insurance deduction. Now let's talk about a penalty on an early withdrawal of a savings account, or CD. If you withdrew money from a certificate of deposit, a CD, or other time deposit savings account prior to your certificate maturing, you may have incurred a penalty for early withdrawal. This penalty is charged by the bank and is withheld directly from your proceeds from the certificate. Where do we claim this? The penalty is reported on Form 1099 INT, typically Box 2. We enter this figure directly on line 30 of the 2016 Form 1040. Moving on to alimony, or alimony paid. Alimony is income to the recipient and a deduction for the payer. The IRS has a line for you to fill in your ex-spouse's Social Security number. Even if you and your ex aren't really on speaking terms, you need to make sure that you both have the same alimony payment in your respective slots. Amounts paid under divorce or written separation agreements entered into between you and your spouse or former spouse are considered alimony for federal tax purposes if the following are true. You and your spouse or former spouse do not file a joint return. You pay in cash, and this includes checks or money orders. And if legally separated under a decree of divorce or separate maintenance, you and your former spouse aren't members of the same household when you make the payment. Your payment is not treated as child support or a property settlement. Not all payments under a divorce or separation instrument are considered alimony. Alimony does not include child support, non-cash property settlements, payments that are your spouse's part of community property income, voluntary payments. Moving on to line 32 on the 1040, IRA deductions. Taxable income can also be reduced by contributing money to a traditional individual retirement account, or IRA. Contributions to IRAs can be made as late as the first due date of a tax return, typically April the 15th, and can be considered retroactive to the previous tax year. An IRA is a personal savings plan that offers tax advantages to set aside money for retirement. So why would you set up an IRA? Well, some or all of the contributions may be deductible, and amounts in the IRA, including the earnings from the account, aren't taxed until they're distributed. You can set up IRAs with banks or other financial institutions, or with a mutual fund or life insurance company, and you can also set up an IRA with your stockbroker. Now let's talk about traditional IRAs versus Roth IRAs. The main difference is when income taxes are paid on the money that's put into the plans. With a traditional IRA, taxes are paid on the back end. That is, when the money is withdrawn in retirement. Typically, your adjusted gross income is much lower when you retire, which gives this plan an advantage. With a Roth IRA, it's the exact opposite. Taxes are paid on the front end, but there are no taxes on the back end when the money is withdrawn. In both traditional and Roth IRAs, money grows tax-free while it remains in the accounts. Almost anyone with earned income can contribute to a traditional IRA. There are income limits for contributing to a Roth IRA, however. Roth IRAs are more flexible if you need to withdraw some of the money early. And with a Roth IRA, you can leave the money in for as long as you want, letting it grow as you get older. With a traditional IRA, by contrast, you must start withdrawing the money by the time you reach age 70 and a half. Traditional IRA contributions are tax deductible on both state and federal tax returns for the year that you make the contribution. Withdrawals in retirement are taxed at ordinary income tax rates, and Roth IRAs provide no tax break for contributions, but the earnings and the withdrawals generally are tax-free. So with traditional IRAs, you avoid taxes when you put the money in. With Roth IRAs, you avoid taxes when you take it out in retirement. Well, how much can we contribute to an IRA? For 2016, the dollar limits for IRA contributions were $5,500 at age 49 or younger, $6,500 if you're age 50 or older. The earned income requirement for IRAs involves the following. To be eligible to fund an IRA for a particular year, you will need to have earned income. For IRA purposes only, earned income consists of wages, which are typically reported on a W-2, self-employment income from a business or farm, and alimony. The most that can be contributed to a traditional IRA is the smaller of your taxable compensation, which includes your wages and earnings, or $5,500, $6,500 if you're 50 or older. For example, Betty Rubble, who's 34 years old and single, earned $24,000 in wages for 2016. Her IRA contributions for 2016 are limited to $5,500. Barney Rubble, who's single, he's a college student working part-time, earned $3,500 in 2016. His IRA contributions for that year are limited to $3,500, the amount of his earnings. There are some deadlines. Funds can be contributed to a traditional or Roth IRA by the first deadline of a tax return without any extensions. That means a taxpayer can make a retroactive 2017 IRA contribution if he or she funds the account by April the 15th, 2018. A taxpayer must be under age 70 and a half to contribute to a traditional IRA. Contributions to a traditional IRA might be deductible or non-deductible, and this depends on your age, your total income, and whether you're covered by a retirement plan through your employer. There's a few other adjustments that we can take to reduce our taxable income, such as the student loan interest deduction on line 33 of the 1040. Interest paid on a qualified student loan may be deductible. A qualified student loan is a loan that's taken out solely to pay for qualified higher education expenses. Generally, the amount deductible is the lesser of $2,500 or the actual amount of interest that was paid. Student loan interest is typically reported to the taxpayer on a Form 1098-E in Box 1. The deduction can be claimed if all of the following apply. Interest was paid on a qualified student loan during the tax year. The taxpayer is legally obligated to pay interest on a qualified student loan. The filing status cannot be married filing separately. Modified adjusted gross income is less than a specified amount, which is set on a yearly basis, and if filing jointly, the taxpayer and the spouse cannot be claimed as dependents on someone else's return. The student loan interest deduction is reported directly on line 33. No other forms are necessary. The tuition and fees deduction, line 34, was set to expire at the end of 2011, but it was extended through the 2016 tax year. So for 2016, a taxpayer could have taken a tax deduction for college tuition and other mandatory school fees. This is called the tuition and fees deduction, and it's again reported directly on the Form 1040, line 34. Form 8917 must also be filled out in order to get the tuition and fees deduction. So in summary, we went over how to identify and claim some adjustments to income, the educator expenses, the deductible portion of self-employment tax, the penalty on an early withdrawal of savings, alimony paid, the IRA deduction, and the student loan interest deduction. Also, we covered the tuition and fees deductions. Now let's tackle some review questions.